Today I wanted to talk about interest rates. Last week we forecast that the Reserve Bank would cut the overnight cash rate from 0.25 to 0.10, that they would cut their target for the 3-year bond rate from 0.25% to 0.10%, and that they would reduce the rate they pay banks on their exchange settlement account, this is money that the banks lodge with the Reserve Bank, from 0.1 to 0.01. So movements right across the board. They would also cut the rate that they charge banks on their term funding facility to 0.1% from the current 0.25%. These are big moves. So why are we expecting that to happen? I think the starting point was a change in rhetoric from the Reserve Bank board minutes, when for the first time since March, we saw the board refer to we are examining other ways in which monetary policy can be used to support the economy. That was new, so that suggested that they were starting to think about changing policy. We then saw a speech from the Reserve Bank Deputy Governor de Bell, where he sounded particularly downbeat about the economy. He talked about prospects for the economy as being a slow grind. He talked about the fact that their forecast for the unemployment rate by the end of 2022 was still 7%, and referred to the point that even at 5% that we'd seen before the COVID crisis, you were still unable to get much upward pressure on wages. He also referred to the fact that policy should err on the side of overstimulating rather than understimulating, and it was encouraging the government to borrow more. All of those factors pointed to us that the bank is likely to further cut interest rates. I think they will also provide the government with more support by buying more government bonds in the 5 to 10 year maturity ranges. So when might this happen? Initially I thought it was likely to happen as soon as possible. That would be the board meeting on the 6th of October. But the board meeting on the 6th of October coincides with the announcement of the budget. And while the Team Australia concept, where all the policymakers got together to announce simultaneously important policies back in March, I think this time it's more likely that the government would like clear air to sell their budget without other policies being introduced at the same time. That means that the Reserve Bank will have to wait until November, and then I think we'll see these interest rate changes. The risks around that outlook is that if the Reserve Bank is targeting a 10 basis point level of the 3-year bond rate, will it be able to sell bonds at that rate? And I think the answer is that because they're lowering the exchange settlement account rate to 1 basis point, banks will look at the possibility of lodging money with the Reserve Bank at 1 basis point or buying government bonds at 10 basis points and be quite encouraged. We're also likely to see the effective overnight cash rate fall to be closer in line with the exchange settlement rate, because that's the alternative for bank investors. So banks can lend their money to the RBA at 1 basis point. Maybe they'll lend them out into the market at 3 or 4 basis points. And if that's the cash rate, the effective cash rate, then the Reserve Bank is able to hold that bond rate at 10 basis points because there's about a 6 basis point funding margin. The other big benefit will be the impact that this pressure on the 3-year part of the yield curve will have on fixed mortgage rates. We've already seen fixed mortgage rates come down from 3.6% to around 2.3%. But if the 3-year bond rate comes down from 0.25 to 0.1, and the term funding facility that the banks borrow from the Reserve Bank at goes from 0.25 to 0.1, I would expect that there'll be downward pressure on that 3-year rate as well. And possibly even that we would see 3-year fixed rates below that 2%. This is all going to mean further stimulus for the Australian economy, encouraging the government to issue more debt, so they encourage government to have a stimulatory fiscal policy, putting downward pressure on the fixed rates for the mortgage market, and of course in the short term anyway, creating some downward pressure on the Australian dollar. My view is that the Australian dollar will soon regain its strength, and we still retain our forecast for 75 basis points by the end of the year. But without doubt, these very, very low rates are certainly going to help the Reserve Bank to put some downward pressure on that currency. Thank you.